So that's out of order. Oh, no, it isn't. I guess I don't know what happened to that thing, but we can see what my last two trades are in the, I'll have to update this. So if you send me an email, charles@riskdoctor.com, I will send you a link to get the newer one. But we could see those two trades. But before we do that, oh God, I'm on page 53. Hang on, 53. Going to page 52 just to see what number trade it was. Trade 14. 14 and 15, I'm thinking. So let's go back to the beginning here. There we are. 14 and 15. Okay. 14 is doing the bear spread, spending $3.19 on a 10 lot, plus commissions over here. And I sold out the next one. Hold on. This was selling a call spread, sorry, for $3.19 credit. And then, why am I selling two call spreads in a row? That does not make any sense. Hello, what is going on here? Come on. Whew, do I have bad data in here? That does not look right. Oh, did I double up? Oh, no. It was 14. Oh, sorry. 14 was taking profits on trade 13. Trade 15 was getting bearish with a put spread. Yeah. Bought that for 86 cents in trade 15. And in trade 16, I sold, the higher strike went out to liquidate my butterfly. I got $3.19 for that one. And so I legged that butterfly for the difference of $2.33, if my math is right, $2.33. And that's what I got after for trade. And I'm flat. I'm flat. Oh, wait. It doesn't say I'm flat. It says I got a 20 lot here. Hold on. Oh, no. No. I'm flat. I'm all boxed off. Post-trade 16, I'm all boxed off. Let's go to that. Let's go to post-trade 16 on about page 54 or so. Well, here's page 54. Doesn't show it. So back to that to show it there because you can see all the boxes. You don't need the dissection. Even you, who never saw dissection, doesn't need a dissection. Here's why. All right, post-trade 16, second from the bottom. We're short a 10-lot combo at the 490. We're long 20 combos. These are synthetic long future stock at 500, and we're short the 530. It's two boxes. It's short a $10 box, 490, 500, and we're long the 500, 530 box 10 times. So there's nothing to dissect. It's flat, right? And what had to happen at expiration June 18th, we were at 498.82 just before the close, and the puts I needed to buy, the only pin risk I had, let's zoom in on here. Pin risk is important. Our timing is just delightful. Okay, let's show what we need to see. June 18th. Going into June 18th, after we have, on June 17th we're flat, but on June 18th we're trading at 498.82, and these, we could trade a box, we could buy 20 boxes anywhere, just involving the liquidation of the long combos here at the 500 strike. Okay. Can I display the strike? Oh, well, it's too high. All right, this middle column is 500, right? But that's trading 80 contracts. A market maker would sell it to us at 510 probably, maybe 505, maybe even 501. But whatever. If it fit him, he'd do it at 500. I'm sorry, at 10 bucks even. I meant even, $10 even. $10.10, $10.10, 10.05, whatever. But the real dangerous option was the unknown if would be assigned was the 20 lot of calls. And some people will say, oh, you should never leg that, but they're a dime. You can't lose. To have a three-legged box and just missing the part that if you sell it out, you might get $10 for it, you know. So you're buying back something that's nearly worthless, and that eliminated all of our pin risk. What happened next is just assignments. So I'm just showing you the effect of assignments. These numbers are supposed to be showing stock, but the trades 18, 19, and 20, they're all results of just the 20 is just things going out worthless, just buying them back and selling them out, just evening up, just clearing it out. And trades 19 is the effect of being assigned on the, you know, it's or exercising the 500 calls that were long. And trade 17 is simply trade 18 rather is the assignment of the call, the 490 calls, and the exercise of the 530 puts. So that finishes our trade. I will get a new image that will show the numbers here where these number signs are. That's an adjustment. You can say how wide your cells are, and so that will show up. And where am I? All right, let's zoom out, and we're on page, okay, back to 100, and let's go. We're going to wrap this up now, and then we're going to open it up for questions. We saw the pricing arcs. Oh, this is just the last. It went to our target near our dot, which is 490, but it landed at 500, $10 away. If we did nothing, the butterfly would have went to 30 bucks, which we bought for 9, and the verticals that we sold for 3, 30 times went to 0. The value of our spread that started off at even money went to $30 or so, and if we were real men, we would have rode it all away and did none of this goofy, sissy adjustment stuff. That's for sissies. All right, now there's all our butterfly arcs, and what's this? Okay, this is when it all goes bad. This is when it goes bad. The next week, we're feeling pretty good, or I was feeling pretty good about that. I just pulled up a diametric grid of Apple. I love Apple. I love iPods. I love iPads. I love it all. I love iPhones. I like BlackBerries better, but anyway. But I think it's all real cool, and I think the company's unbelievable, and its market cap is more than Microsoft's now, if you've ever noticed that. So let's zoom in on this. By the way, has anybody been to a Microsoft store? It's like an Apple store, only even better. Wow, went to one down in Phoenix, in Scottsdale. It's amazing. All the Xbox games you can play over there. Anyway, keep an eye on Microsoft. All right, now, when it all goes bad, okay, what we did here is diametrically I projected that we would be at 300 by our July expiration. Is that July expiration? No, that's August expiration. July expiration, also 300, right in the middle of this grid. So I bought the 270, 300, 330, and here we are. But the next day, as we creeped into the green, I'm going, wait a minute, we could drop like, oh, and by the way, I sold the 260, 250 put spread, which at expiration will be out of the money, but with time to go, it's going to be in the money. So I was a little overzealous, a little high on my horse for the great Google trade, and put this on without really examining it. You know, it's like 5 minutes to go in my coaching clinic. Says, oh, let's put this on. And I realized the next day, oh, wait a minute. So as soon as it entered into the green, I said, let's buy back the put spread. So the financing spread, that short vertical, the thing that could go to 30,000 bucks, I bought it back. I still was bullish. So I hung on to the call. I should have got out of the calls too. I didn't. So even the best of us make mistakes. And no matter how good you are, you will still make mistakes. But, you know, I rolled it down, the butterfly. I got rid of one of the verticals. I tried to maintain something long, and it got into the green area. Here's the results of it. But when it got into the red, I said goodbye, and I salvaged what it was. And, you know, it could have been very painless if I didn't do the trade in the first place, because it didn't warrant being traded, that one. And at least I got rid of, I mean, because Apple eventually did expire below the low strike of the puts, and I would have had to pay back 30,000. It would have been ugly. So that same guy is too manly to do any adjustment. He would have taken pipe on that whole saga there. Here's this next one is while we were doing this in Google during the live trade of Google, somebody emailed me about an iron condor, and they were using an earlier version of Trade Tracker. This is vertically displayed, and the yellow is where the underlying was at each of these dates, and it was going bad on her. This iron condor, calls on the left, puts on the right. These are the strikes. And as the market was creeping down, she was bobbing and weaving and rolling away and stuff like that. And so she was in a predicament, this woman. And I write down here what you could do. So it's in your PDF about that. And it's basically, you know, rolling away some of the risk and, you know, playing for a better outcome. And that's what she did. She rolled away the May put vertical to June. See, here's a property of verticals. When it was right at the money, the May vertical and the June vertical are going for the same amount of money. But the curvature, because this was coming into expiration, May 20th. When was May expiration? May expiration was the 21st, so she had to, you know what, or get off the pot, right? So she had to do something. So what I advised her to do is roll the May into June, and that will make it move slower. And then you can get your bounce, because it was near support, but she couldn't take the heat anymore because it was near expiration. But she can have the cushion now of a vertical that had more time to go. So let's see, is Thinkorswim open? It is. We can simulate this in any stock. And let's look at August with, well, July 4th has 2 days to go. Imagine you did a simulated trade, analyze, Google. And let's clear this out. Delete. Okay. And let's imagine that we're at 477, which is halfway between no even strikes. So it's, but let's see. Let's do it anyway. Let's sell the 470. Let's sell the let's do a big one. Let's do, sell a 490 deep wide 1-1 2-strike vertical. So we're selling at 490, 470. It's going for a little more than half price wide. It's a little bit south of 480, which is right in the middle. But at 480, you know, every month is about the same price because it's kind of a time-proof spread with regard to gammas and vegas and thetas. So what if we were to do a vertical roll? Let's look at less strikes. Let's look at only 4. And let's, do we have 470, 480? We do. And let's look at the price of, this is analyzed. So let's analyze, you know, selling one of these too. 490 sell deep wide vertical 1 month 2 striker vertical. So that's going for 10. All right. It's because of the skew and everything, more time to go, and it's because it's not, you know, it's not as affected. But what I want to show you are the graphs. Risk profile.